Well, it's 10 o'clock, and I think everyone's managed to come in through the waiting room. So welcome to you all for joining this monthly call hosted by Nikko Asset Management. Great lineup of speakers this morning. But firstly, you probably noticed if you've been on this call a few times that the background for me here is a little bit different to normal. So I want to firstly express my thanks to Waikato Tainui, who are hosting me down in Hamilton today, in order that I can still participate in this call whilst travelling on the road. So thanks very much to them. Also, for a number of you, you probably won't have met Brett Winton before. Brett is the Director of Research at ARK Asset Management. He's familiar to a number of us on the call, but I don't think he's actually participated in one of our webinars before. So welcome, Brett. Thank you for joining us. Brett, we're really interested in what you're going to say. I'm going to throw this over to you in just a minute, but I believe the broad thrust of what you're wanting to take us through are some of the big ideas for 2021, what you're looking at within ARK, and also in particular, answering some of the questions that sometimes come up around, has this whole area of disruptive innovation, is it starting to peak? Are we reaching the end of this road? Are we starting to see sort of capacity constraints and those sorts of things? So as you look into the future and where you think this is going, we're really interested to hear what you've got to say. So I'm going to hand over to you, and maybe a little bit of time for Q&A at the end of the 30 minutes.
Yeah, and actually I may bail into a presentation, but I'm more likely going to try to just go off the cuff and talk about how we think about markets and innovation, and try to be responsive to the Q&A, because I'm sure a lot of people have those questions and you're getting a lot of inbound. So if you think, first of all, ARK Invest, we were founded in 2014. Kathy and I got together and said, what's the best way to align portfolio management and research to invest directly in disruptive, innovative technologies? And the reason we thought it was the right time to focus on disruptive innovation is because it's a unique time in technological economic history. You really have to go back a century to see the amount of technological foment that's happening today. A century ago, it was the telephone, electrification, and the internal combustion engine. Today, we think there are 5 fundamental innovation platforms. The way I think about it is future historians will look back upon this time period and say, oh my gosh, gene sequencing and editing, AI and neural nets, collaborative robots, energy storage, particularly working through the drivetrain and mobility space, and cryptocurrency, were all hitting critical stages of inflection and cross-sector penetration, all in the same market cycle. And it's really unprecedented, and actually there's a lot of value creation happening as a result of that. And so kind of within the context of asset management, you should focus on the area where the most value is being created. And so from our perspective, it seemed natural that you would want to set up portfolio management and research to focus on exactly that most fertile terrain for both value creation and misunderstanding. And so kind of those are the 5 technology platforms that we think future historians will say that was as big as computation or as big as the internet. And we use a framework for identifying those where they all follow steep cost declines. They all are cross-sector technologies. And actually that's a strong kind of test for whether or not something's ready for a critical stage of inflection. And they're all platforms on top of which other innovations are being built. And those characteristics actually align really poorly with a lot of the kind of structural impediments that traditional buy-side managers have or have evolved over time that tend to make these technologies more misunderstood. Steep cost decline doesn't manifest in 3 or 6 months. It's actually the drama of the unit demand you get is over a medium-term time horizon. But Wall Street, for all kinds of reasons I could go into, is increasingly time compressed in terms of its ability to look forward. The media environment's a contributor to that. Going into passive funds, you're literally investing while looking in the rearview mirror, hoping you don't run into a tree. Even within the hedge fund space, it's people get paid based on the performance of their fund annually. And so, an analyst who makes a good call as measured over 5 years is going to get fired before that 5 years occur. And so we intentionally take a medium-term point of view. All of our underwriting of individual securities is over 5 years. We pretend as if we're going to be a forced seller of our positions 5 years from now, meaning that we don't we don't act like we're selling to techno optimists. We say, given this, what the business is going to look like 5 years from now, and the cash flow we think the business could generate, what would someone who's going to pay a normal market multiple for cash flow, given the margin and capital intensity characteristics of the business, pay for that business? And so we really try to actually be quite conservative in our underwriting, but we do it over a time frame that we think is appropriate for the duration of the equity market. Technologies that cut cross sector are misunderstood, particularly by sector specialists. The automotive analyst just doesn't have the time to figure out how the cost declines in batteries is working, or even to compare it against fuel cells, which we've done a lot of work on. And so they basically rely upon the executives that they talk to kind of let them know when it's a technology that's reasonable and interesting to pay attention to. And they've been misserved by doing so. And so we assign our analysts by technology rather than by sector. And that allows Sam, who covers batteries for us, for example, to think about where exactly in the value chain the value is going to accrue. Is it in the utility space? Is it in the renewable space? Is it in kind of the battery component supplier space? Is it the battery manufacturers themselves? Is it at the tier one suppliers? Like, where is the cash flow going to accrue as a result of the transition of the drivetrain over to electrification? And then, because these are platforms of innovation, traditional Wall Street has a very closed-minded attitude towards the information it generates. We think that's really dangerous when you have platforms that you can't pre-imagine all of the ways in which they're going to be used, and the fail cases, the ways in which they're not going to work, and it's not going to be possible for them to kind of navigate in that direction. And so your only hope in kind of staying current and keeping your probable state of the world point of view accurately reflective of the reality of what these technologies are capable of is to attract a lot of information to yourself. And so the way that you do that, and I think within the internet age, is you provide a lot of information. So we're open with our research. I might not even run through any of it, but I'd encourage you to look through our Big Ideas deck. It kind of gives you a glimpse at some of our forecasts. That information generation attracts a lot of people who want to talk to us about, oh, how did you get to that battery cost decline? Have you thought about solid state batteries, what that means for Tesla's positioning in the marketplace? And so we're not going to be the expert on all of these technologies. In fact, the Venkat, who's a theme developer for us at Carnegie Mellon, is much more expert on lithium-ion batteries than us. But we do kind of like the business model ideation about how is this thing going to piece together? What do we think is a reasonable forecast? And then he serves as a great sounding board for saying, oh, well, this is how you should think about how these characteristics of these batteries will change with solid state batteries. And this is what I'm seeing in the lab in terms of their manufacturability. And so kind of having an open, we call it an open source research ecosystem, really allows you to not shut yourself off from the areas where you might be wrong and where you might be right about the likely future state of technology. Okay, so those are the inefficiencies that we exploit in the equity market and when we put our investments to work. So far, we've been successful. The question now is, oh, well, but there's been this huge run up and everybody's focused on innovation, and suddenly every time you open Twitter or the newspaper, ARK is in the news. Is the show over? Have we reached the end of the game and the game has stopped, I guess, is the question, right? So let me set up the state of play. So of the 5 technology platforms, there's 14 underlying technologies that we focus upon that we believe are that kind of in our taxonomy, they construct to build up to those 5 platforms. And they're all at critical stages of inflection. They are all investable, and they're all areas where we think cash flow will accrue within kind of the competitive landscape. And if you look at our underlying attribution of market cap to each of those 14 technologies, and you stack it up at the end of 2019, you had roughly $7 trillion in attributable market cap across those 14. And so to give you a sense, that was roughly 10% of global equity markets. And end of 2020, sorry, that was, 2020 passed so quickly. End of 2019, it was 7 trillion. End of 2020, that same stack was 14 trillion. So kind of disruption of the coronavirus clearly pulled forward the adoption curves on a number of our technologies. Companies, like when you go from a blank slate and people are just forced to, they're not just going to stick with the decisions they've made, they're forced to reevaluate their decisions, how they're operating in the world. Disruptive technology tends to win, because typically the economics and productivity generation of a disruptive technology is much higher than the status quo ante. And so kind of on top of which, everybody forced into digitization, businesses all having to go online like this, there's a lot of productivity generation you've gotten out of that transition. And the assets have performed, and so people have poured money in. And so the question is 7 trillion to 14 trillion. Okay, so now it's like 20% of global equity is in this technology stack. Is that overvaluing kind of like where the ultimate horizon is? And from our perspective, that's absolutely what our job is to do, is to look at both at the technology level and at the individual security level. How do we underwrite our positions to make sure we're providing a reasonable return on capital for our clients measured over a reasonable time horizon within the equity market? Well, the good news is, across our portfolios, especially after the last few days, on the underwritten positions within our forecast set, we still think we have a lot of inefficiency in the market. Now, I reserve the right to be wrong with my forecast. So everything I'm saying is not a promise of return or anything like that. I'm just saying the way in which our 5-year price targeting looks is that we have still over 5 years, more than double in the portfolio. And if you go at the technology level, so if you approach it from the top down level, where we look at our attributed value to each of these 14 technologies within the stack, we think that by 2025, there will be $28 trillion in attributable market cap to these technologies. And then by 2030, roughly 75 trillion. So you can think that it's 75 trillion is basically the size of the global equity market today. So you can, a crude way to think about it is like, we basically expect, if you could somehow get efficient exposure to all companies exposed to these technologies, the value of those exposures would roughly double if you could somehow index it, right? So that's where I at least take comfort that, whatever happens today, I think I'm putting good money to work that will provide outsized return as measured over 5 years. And actually, if you look at the expectations for growth in that 5th out year, across our technologies, most of them are still in an inflection phase. And as in, I think I'm going from 28 to 75, so a more than double again. So it's not like I am just getting to maturity at 5 years. We actually think that they will still be in kind of a state of growth and penetration at that time frame. So that's kind of the overall.
One area that links in with this, which we get a few questions on, is when something has run so hard for a period, like as you say, it's doubled over the last 12 months or so. The question that often comes is, what happens if people want to sort of cash in some of those gains, and we start to see some of the cash flows from investors turn? Does that affect marginal pricing? Are you going to struggle with some liquidity if people want to take some gains, if those cash flows were to reverse? And are you seeing any I guess evidence of that?
Yeah, for us, the short-term volatility is actually good in that typically the way in which we are managing the portfolio is that the market's latest mania operates at a different vol cycle relative to our fundamental pricing of the positions. So you can see it in how we've managed Tesla over the last, call it month, right? Where Tesla has been the largest position in the portfolio continuously. It got up to, north of 10% as we were taking gains off of it. And then over the last month, it's traded down. And we've begun adding to the position, because it's trading down relative to our price targets. Our return is improving upon it. I think that there's there's like a slightly broader question, like the market. There's clearly a lot of like signs of misbehavior in the market, broadly speaking, as in the GameStop thing, a lot of retail options activity. Our actively traded ETF is being heavily shorted right now, which I don't think is a sign of good health. Not casting a value judgment against it, but it's like and there is clearly like options activity on our actively traded ETF. I don't think that's an appropriate way to invest in an actively managed fund. And there is not that is what it is, right? Like the way I think about it and the way I think about my own exposure to our funds is, when I'm investing in equities, my time horizon is consistent with an equity linked duration, which is not 3 months. It's like at least a business cycle. Like if you are worried about what's going to happen over the next 3 months, then you're in the wrong asset class, right? And so like your mix of assets should be what controls against the vol in the equity market. You can look at the total equity market and say, oh, well, it should normalize to a something PE or something. Like, the equity market could be down 30%. I don't know. I actually think it's easier to forecast what's going to happen for us over 5 years than it is over 3 months. And I feel confident about the 5-year point of view. Now, I think Kathy has her own point of view on that, which is she believes that there's so much money in bonds and fixed income that if it begins seeing underperformance due to rates rising, that could kind of like try to find another home in the equity market. There's clearly a lot of people trying to stay wealthy out there who are accepting, subnormal returns in kind of coupon generating assets. I think that from my perspective, I'm able to put client money to work in really inefficiently priced assets. And so then I feel good about, additional client money. Does that make sense?
Yep, thanks, Brett.
Yeah, I mean, I think that one of the funny aspects about, or actually just like another thing is, like if you look at some of the assets that are priced out there, we do the work on them and we absolutely think they're overvalued and we don't invest. Like that's our job, right? So, we've done a lot of work on fuel cells. It's very clear to me that kind of the companies that are tied to fuel cells and that narratives that people are building around expectations for fuel cell deployments are not reflective of the actual unit economics of those technologies in the future. And so those assets are the securities tied to those assets are inefficiently priced in the opposite direction. And so from the perspective of someone who is not just hearing something amazing at a cocktail party and deciding to invest in it, but instead saying, oh, let's actually do the work and understand the cost decline there, model out the unit economics for that exposure, attribute the, what is the actual, we believe, 5-year value of that security. It gives us a lot of opportunity for, doing well by our clients with good exposure selection. And so particularly in kind of like this SPAC space where companies are coming out with, I would say, lighter and perhaps inappropriately light levels of disclosure as to what their actual business prospects are. There's been, I think, a lot of good work that we've been doing. And in terms of thinking about how to deploy, invest relative to an environment where a lot of things are going up that don't make sense. it gives you good opportunity to exhibit selection.
Yeah, and clearly it's been a phenomenal run of success, not only in terms of performance for a number of the ARK strategies, but also cash flows have been exceptionally strong over the past 12, 18 months or so. Has that caused any particular problems or strains within the process that it's almost been, the cash flows have almost come too quickly or too hard, or have you, just give us an understanding as to what that's meant for your process and finding the companies that you like.
Sure. The process hasn't changed. I think that there's if you think about the way research and portfolio management interacts, we're kind of generating kind of the scoring for the company. So we have 4 subjective scores we do for each company, plus a thesis risk, plus our expectations for returns. And then giving guidance on incremental news so that the portfolio can be traded tactically relative to what's happening within the world. And there's no doubt that we have more market impact with our decisions now than we used to. And that has benefits and drawbacks, right? So if we want an allocation in an IPO, we can get it. Right, that previously was not available to us. We did not have the same attention from, investment bankers and management teams that we currently do. And because we have like a 5-year price target, if there's a price impact on a security that we invest in, because people have seen that we've invested in it, and then it gets bid up, we're going to be we're not going to continue to chase price. We require a 15% compounded return to put money to work. As measured over 5 years, and sometimes it'll appreciate beyond that, and we have other places to go. At the same time, narrowly, that initial money in, actually the IRR on it is very high because you put some money into a position and it appreciates meaningfully just on the basis that somebody knows that you've signed off on it with your seal of approval. That is what it is. I think that there's also even at the information generation level for our entire research team, like we get more information flow than we previously did. So if the kind of seeking to understand and develop forecasts for the future in any area, we can easily, talk to the companies and the product leads in the private or public space to help us refine those forecasts, to help us understand the critical weaknesses and strengths. So I'd say that in terms of the portfolio management, there's more opportunity because of the vol that induces. In terms of the research, there's more basically access to information if we want it. And then the counter to all of that is, like, ideally you're always entering the marketplace and getting exactly the price you want for the asset you want at the time that you want it. And practically that doesn't happen with a very small cap stock. If you look at our historical outperformance, it hasn't come from small cap stocks. So it hasn't, I don't think that if you look at our expected returns across the entire portfolio right now, I think Tesla's a top 5 in terms of inefficient pricing in our view, right? Meaning, and so that's not a small cap stock. It's quite liquid. So that gives you a sense. I think that clearly the state of the business has changed. We're hiring another analyst for Asia. We're gonna add a fintech analyst. So we have more research resource to work with as well. And then, like, you can back up a step and think about within I guess our quarter end fourth quarter end AUM was something on the order of 58 billion or something like that. We think that the investable pool we're operating in is $14 trillion. So there's not, would you be, there's not a situation where I'm like, oh, I don't have enough ideas right now that are inefficiently priced. That's not an issue for us at all. I think that there are like ways in which we're being tactical about how we deploy, but we don't lack for opportunity by any stretch.
Do you have a minimum cap size of stock that you are prepared to invest in for liquidity reasons, and has that changed as you've grown?
I'm not like the expert there to answer that question, but from a research perspective and things that we're interested in researching, we haven't changed our process at all. And the reason I can't, it depends on kind of the product and the prospectus of the product. I think there's some variance there. So that's the, short answer.
Yeah, Brett, I'm conscious that we're just about out of time. You're going to leave us with one big thought from the 2021 outlook. Is there one thing that you draw our attention to and want to highlight to us?
Well, I think the most exciting space is robo-taxis. Like, I think that basically the cost per mile to go from place to place has been the same, or go from point to point in a car, inflation adjusted, has been the same for 100 years, like 75 cents. And the Model T, you bought it and you account for all the maintenance and everything else at 75 cents. If you can deliver robo-taxi, meaning that cars drive themselves, you ride in the back seat, we think that'll profitably price at 25 cents a mile. And so you create, it's this, for one thing, it's like a lot of innovation. It takes non-market activity and it turns into market activity. We're all amateur drivers and some of us are very bad at it, right? So you take out that non-market activity that you're not getting paid for and you turn it into a market service layer. So there are, I won't walk through all the math, but it's very easy to underwrite and forecast to more than $1 trillion in operating earnings for the robo-taxi platforms that provide that service. And I don't know what you want to pay in terms of a multiple of operating earnings on a software platform, but the market right now is paying 19, 20 times, well, actually well north of that, but at equilibrium, kind of like the 19 times, for stable platforms. Okay, so then that would suggest a $20 trillion market cap opportunity there. That's in 2030. So it's like creating a new sector out of broadcloth, right? And right now, if you look within, we classify those within energy storage. If you look at the way in which the market's appreciated in the SPAC space and the ex-Tesla space, it's been in a lot of electric vehicle manufacturers that haven't really produced electric vehicles in a meaningful volume yet. So there's actually been kind of appreciation, I think, in the wrong spot, in part because there's not like clear investable assets tied to that, aside from Tesla, and you can get a stub in Waymo, and GM has some exposure, but we have some concerns there. So the potential for like a monumentally large company in that spot is very high. And if you look across our forecasting, across the 5 technology platforms, the incremental value accrual from a growth basis is actually more in the robotics, energy storage, gene sequencing, editing, and cryptocurrency space rather than the AI neural net space. And so that a lot of people are trying to get innovation by being basically allocating to the hyper large cap tech. It means they might miss, or at least they're not well positioned yet for some of these vertical exposures that we think are going to accrue a lot of value within disruptive technology. So,
yeah. Brett, look, we really appreciate your time. We thank you for your insights, and we look forward to hearing more as this journey evolves over the coming years. And you've given us a little taste for the future, and we'll wait to see it happen. Thanks very much indeed for your time.
Great. Cheers. Thanks.
Cheers, Look, we're going to move from the US now back to sunny Auckland, where I can see that our portfolio manager, Ian Bellew, is waiting to pick up the microphone. Ian, there's quite a bit of conversations going on around inflation outlook, bond yields rising, concerns just over what the next stages are as we come out of COVID. So I'll just throw this open to you. What are the things that you're thinking about and that you'd like to leave with our investors? Thanks, Ian.
Thank you, George. Good morning. Yeah, as George said, there's been quite a lot of interesting things happening in bond markets. So I'll start by addressing the elephant in the room as far as bond markets are concerned straight off, and that's been the quantum and the speed of the rise higher in yields, both here in New Zealand and offshore to a lesser degree. So I want to preempt the discussion straight off by just saying up front, should you push the panic button on your bonds? No. They're still performing their role as a diversifier in the portfolio, and perversely, yields are a lot higher now, bonds are a lot cheaper, so it may actually be a good time to start chipping into bonds at much higher yields. Just putting some context around the moves where bonds have come from. The lows were hit around about October last year, and the 10-year bond at about 30 basis points. The 10-year bond is closer to 2% today, so we have seen some quite big moves. And also the larger moves have occurred further out the yield curve. So we've seen a steepening of the term structure. Longer bonds have had bigger moves, higher in yield than shorter bonds. Looking at the reasons why, there's no one smoking gun responsible for the move in bonds. But if you cast your minds back, go back to late last year, it looked like the sky was falling in. New Zealand is perhaps in some ways leading the world, that we managed COVID very, very successfully in comparison to other markets. So we've been the first to come through the recovery, that V-shaped recovery, and investors offshore have been looking at New Zealand and saying that we think things are improving. Indeed, the data has supported that. Quite a big surprise today the other day when we had our unemployment numbers out, they came out at 4.9%. Which is a relatively low unemployment number. Also, inflation has been moving back towards more normal levels. So people talk about bonds selling off because of the reflation trade. What they're really talking about there is that, if you go back 6 months, there was a lot of concerns around deflation. So very low or negative inflation prints during the worst of times. And the latest inflation outcome was around about 1.5%. So we're not talking about inflation getting out of hand, 5, 6, 7% like we saw, starting in the 1970s and the 1980s. All we're talking about is a return to more normal levels. The main indicators that the Reserve Bank look at for inflation are perhaps a little bit higher than that, around about 1.8%, and to some extent, forward expectations of inflation are perhaps self-fulfilling, because people think that prices are going up, they will also increase their own price expectations. Another reason why bond yields have been going higher is it just hasn't really been a lot of flow on the other side. So we've seen a lot of sellers, particularly in New Zealand. New Zealand has moved higher and faster in yields than the rest of the world. And that's because, partly we've just come back to a new year. People have been very uncertain about which way markets have been going. So a lot of bond investors have just been letting cash build up in their portfolios. And in turn, that's reduced their duration or sensitivity to rising interest rates. And that's something we've been doing in our bond portfolios to reduce the exposure or damage caused as the interest rates go higher in yield. Perhaps another key reason why interest rates have moved higher in New Zealand than the rest of the world is, as I said, that New Zealand has recovered a lot quicker. And we were a big outperformer last year, that New Zealand yields moved lower than the US and also lower than Australia. So that's quite unusual. And often you'll find that one market that outperforms in one period will have to play some catch up or give back in a following period. So you've seen that New Zealand yields started moving higher, and now we've seen US yields move higher. In fact, overnight, there's quite a big knee-jerk reaction in US yields where they jumped about 20 basis points, but subsequently unwound about half of that. And Australian yields have been moving higher as well. So there is some concern, which is not necessarily unfounded that our rates have adjusted to more appropriate levels, but do we get the second round effect or spill over as the rest of the world starts to normalise their rates, given that they're behind us in their recovery? Something in particular to note is that there's been a large increase in the savings rate in the US, and that's partly because of all the stimulus. There's an unprecedented amount of stimulus still to come. It's quite arguable whether they actually need it or not at this stage. You've got vaccines, which are certainly probably a slow resolution to the problem, but they will eventually hopefully resolve COVID. And very different to New Zealand, I said there's that large pool of savings in the US, but people haven't been able to go out and spend it. So New Zealand, we've been going about our normal lives, I guess absent tourism for quite some time now. So we're seeing quite a big retail spend in New Zealand, but that's still to occur in the rest of the world, and that could possibly push bond yields higher again. So when we're managing a bond portfolio, there's three levers we typically look at, one being duration, the sensitivity of the fund to rises or falls in interest rates. Bonds 101 is that the longer maturity of the bond, the more sensitivity it has to moves up or down in interest rates. So we have been selling longer maturity bonds in the portfolio, and also reducing the aggregate duration or sensitivity to interest rates on the fund. The third lever that we look at is security selection. So that's really credit for us. Credit has also been interesting. The supply-demand dynamics in New Zealand remain very supportive. Over the course of this year, we've still got about 15 billion of maturities to come. That's ex-government bonds. So around about 4.2 billion of that is banks, and 2.7 billion will be corporates. There's certainly been an expectation that banks are unlikely to issue in this environment. So banks can borrow from one of the Reserve Bank's lending facilities, the term loan facility at OCR rate, for a period of 3 years, so they can borrow at 25 basis points. Westpac perhaps surprised the market. They came out and did a five-year bond deal, and they paid a credit margin of about 55 basis points for that. At the time, it was an all-in rate of 1.4%. So you can see we can borrow it 3 years at the OCR rate of 25 basis points, and you're effectively, borrowing 5-year money as a bank at 1.4. That their break-evens in the back end for years 4 and 5 are quite expensive. But the reason treasuries do that is they're concerned about, managing their roll-off or maturities. They don't necessarily want to borrow all the money off the Reserve Bank, then have a large amount maturing in one period that they have to refund. So that's part of them managing their book. Also, I talked about the move higher in interest rates. Just to put things into perspective, that Westpac bond that was issued at 1.4% is we just bought some this morning at 1.9%. So you can see why bonds are starting to look attractive when retail term deposit rates are about 70 to 90 basis points. If you went back, sort of 6 months ago, people would be you'd be mobbed if you could offer an interest rate of 2% on a 5-year rate. So we are actually getting that now, which is a lot better than you can achieve as a retail investor. I'm looking at some positive.
Ian, what do you think that means then for mortgage rates? If banks can borrow at such low rates for the next 2 to 3 years, do you think that means that mortgage rates stay pretty low for the next year or so, but that they could start to rise again, possibly even materially 2 to 3 years down the track?
Yeah, so we just had the Reserve Bank out this week, so it's the first comment they've had since November last year, and that was very much their line, that they want mortgage rates to stay low. And they put the pressure on the banks if they borrow through the 10-term funding facility that they don't want to see margins expanding. But as we said, that mid curve and back end has already moved higher. So mortgage rates are fairly flat at the moment. You can borrow around about 2%, 2.25% in the 1 year. 3s, 4s, maybe 2.5%, and close to 3 at the back end. But I think at some stage, even though the Reserve Bank wants to see those mortgage rates go, stay low, that there will be pressure on those, 4 and 5 year rates. Maybe not in the next sort of, 3 to 6 months, but if this carries on, the back end of mortgage rates will go higher for sure. You know, there has been some good news as well. It's quite a surprise. We've been on positive outlook as a sovereign since 2019, and New Zealand just got upgraded to AAA. There's only, I think, 4 or 5 countries in the world that are rated AAA in their local currency. Also, as a result of that, they also upgraded the LGFA, Kangiora, Housing NZ, Transpower, and also 6 local authorities who were previously capped by their sovereign rating. What does it mean for buyers of New Zealand bonds? We're not quite sure yet. It probably depends if we become zero risk weighted, but yeah, it means that probably offshore investors can hold more of New Zealand bonds given the higher rating, and then maybe new investors who look at holding New Zealand. But the challenge at the moment has been that our buyers have largely been absent of the market, so that's what's been exacerbating the moves higher in yield. Even last night, just talking to the guys in the US this morning, they said they've seen a lot of buy side interest in physical bonds, so they're scratching their head why interest rates move so much higher. But the US is very different, that it has a very deep and active futures market. So sometimes the derivative markets can push the bonds around. Talking a little bit more on how the portfolios are made up. As I said, when you're more uncertain as to what the future is, when you have a lower conviction, then it's only natural that you want to, I guess, dial back the amount of risk you have in your portfolios, and that's what we've done. We do think that bond yields look attractive, and a lot of people have been talking about that. But over the course of this week, yields have gone another 30 basis points higher. So we'll be very cautious around where we go to from here for the funds. But perversely, you've had this big adjustment, and now yields are a lot higher. So bonds should perform better going forward. But we probably have a little bit of time to go yet before we really turn things around. We'll probably wait till we see other buyers with some more confidence in the market. We have been seeing spreads as well. When we're trying to buy bonds, people are expanding their buy-sell spreads, just a reflection of the volatility or the uncertainty in the market. And just to give you some guidance on what returns have been on bonds year to date. So if you're following the Bloomberg Government Bond Index, your returns are probably, the index is probably going to finish the month somewhere around sort of 2.75 to finish the year, around 2.75 to 3% down. If you're following, the Bloomberg Corporate Bond Index, then that's probably going to be, somewhere from 1.5 to 2% down year to date. But as I said, a lot of the move higher in yields has probably already occurred in New Zealand. What would see rates go a lot lower? The obvious things are that central banks probably aren't so much concerned about the rise in bond yields, but what they are concerned about if that spills over to other risk assets, particularly equities. So you could see the US Fed come out and make some soothing or supportive comments if equities start falling sort of 1%, 2%, 3% day on day. Also in New Zealand, if we don't actually see the stronger data come through, or if we had another flare up in COVID, that would give people cause to rethink the level of bond yields in the market as well. So I'll probably just pause there for the moment.
Thanks, Ian. That was a great summary. And if bond yields stabilise at these levels, then as you're saying, then the yields improve for investors, and that's going to be a helpful feature for the bond markets. And we'll see what the rest of the year holds in store for us. So okay. with that, and well done on finishing on time. I know it's not a lot of time to try and work within 15 minutes. So we'll as just a bit of seat swapping happens in our Auckland office there, we'll welcome into the hot chair and microphone and camera on to Michael Sherrock, who many of you I think have known and met him a number of times over the years. Michael's one of the 3 portfolio managers in our equity team. He's responsible for the listed property fund as well as the New Zealand equity fund. So Michael, welcome here, and I'm just going to throw it over to you to talk about a range of issues, the things that you're thinking about in the portfolio. I'm hoping that utilities might come up as maybe an area of possible interest, or maybe you want to stay clear of that and just touch on some other areas, but we're in your hands.
Sure. Thank you very much, George. Initially, I just want to touch on a few of the things that Ian spoke about in terms of bond yields and their relationship to what's going on in the equity market. So I'll share a slide to start with, so I won't be sharing any more than one slide, so bear with me as I pull this up. So hopefully you can see that fine. So what we've got here, something that we think about in the equity team is the relationship between the 10-year bond rate and the earnings yield of the equity market. So effectively the inverse of the PE ratio. And so, Ian talked about the pretty dramatic move in the bond rates. And so here we've got the New Zealand 10-year tracking up quite dramatically in the last few days. But these are monthly data points, but updated to yesterday. So what you can see is that spread, the yield premium on the market to the bond rates compressing a fair amount. Traditionally, it's been about 2.2% over the last 5 years. That spread at the moment, Ian spoke about 2%, so this chart with the 10-year rate's about 1.85 as it yesterday, so it's moving fast. So that spread now is about 1% between what's on offer in the equity market from an earnings yield versus the bond market. So that leads us to think about what that means for the equity market going forward. Now effectively, there's three variables displayed on this chart: the 10-year rate, the prices of securities in the equity market, and the earnings of those securities. The bond rates are moving up because economic data is better than expected. So that does flow through to what is expected to come through in earnings of companies and securities that we can invest in. So ultimately, we do think that there will be an earnings pickup, which will push that equity market earnings yield up from here as well. So we've just been through reporting season, which I'll touch on shortly. We've certainly seen a price reaction in the equity market as well, month to date, which we can touch on as well. But there's been some suppressed earnings from COVID, which are still reflected in this chart, which will flow through. There's a recovery, whether it's tourism-related stocks, which will be a little bit further dated, or some of the cyclical names, which are more closer in terms of realising some of those uptick in earnings. So we're still confident in the equity market, and in particular in terms of what we invest in. Bond proxies are a bit of a risk given the move in the bond rates, but in terms of where we're positioned, we own no of what I deem the expensive property stocks, and we're pretty well positioned in terms of those lower yield names across the portfolio as well. Certainly something that we consider, and we've had a pretty good discussion about that this morning in terms of some of our exposures in that area, and where we positioning our portfolio appropriately as we think is appropriate. So if I just stop sharing that screen, just bear with me. So, all right, we're back with you now. The next one I want to touch on is the iShare Clean Energy ETF and the impact it's had on a couple of our utility names. So it's an ETF that tracks an index. It saw some massive inflows late last year and early this year. And given it's effectively an index tracking ETF, the money that comes in, it's just indiscriminate in terms of where it pays for stocks. So two names that sit within that ETF in the New Zealand market is Contact Energy and Meridian Energy. And so the money came in and it just was forced to buy those two stocks. And those two stocks in early January hit all-time highs. What also occurred earlier this month or late last month was a consultation paper about some index changes, which meant that there was a likely down weighting of those two New Zealand names. So we did a fair bit of work around that within our team and what that meant in terms of end weights for those two names. And look, it does mean a very big down weighting in those two names in terms of value that needs to be traded at the rebalance date, which is mid-April. And so on the back of the work that we did, we started selling our Contact position, which was about a 3% overweight at one point. So that's now sub 1% overweight. It's still a stock that we do like from a valuation perspective. And Meridian, which was about a market weight, and that's now 50 basis points to 100 basis points underweight in the portfolios. Just really on the back of the flows that we see coming as this ETF needs to rebalance. Something else that occurred with Contact as well, with its result last week, was a $400 million capital raising. This is probably the first time in my memory that we didn't participate in at least our pro rata of a capital raising. You need to take your pro rata so that you aren't diluted. With this capital raising, we actually took zero stock at all, which is quite unusual for a company that we actually do like from a valuation perspective. But with the what we view as some pretty chunky flows to come from this ETF rebalance, our view was that we could pick up the stock cheaper going forward. And look, that thesis is playing out at the moment. So the capital raising was done at $7, and the stock, when I last looked, was about $6.80. So at this point, it's working out. And our next decision-making point really is, when do we start buying back into the stock on the back of those flows? So we'll be working through that with the view that, as I say, we do like the stock. So ultimately, we'll look to build our position back up to sort of where it was previously, all else being equal, in the light of what's going on in bond markets. That just brings me through to reporting season. So it's been a pretty hectic week this week. We've had at least 23 New Zealand companies report this week, along with a host of Australian companies. We've had our usual management meetings on the back of those as well. So I just wanted to touch on a few stocks that are relevant for our portfolio or are of interest to viewers and listeners. So Spark, which is top 3 overweight in our core portfolio and a decent holding in our concentrated fund. This result was fine, and more importantly as well was the confirmation of a 25-cent dividend. So that puts it on a after-tax yield of close to 5.5%. And despite what's going on in the bond markets, we view that premium over the bond yield as being still very, very attractive. And also, it's a company with very reliable earnings as well. So we're still very comfortable with our holding there, and the return that it offers. And then a couple of tourism-related stocks. So Auckland Airport and Air New Zealand, their results were pretty irrelevant, really, given the border closures and therefore earnings destruction. But the one more of interest is Air New Zealand. It's not held at all in our portfolios. It probably needs to raise about $1 billion or $1.5 billion to recapitalise. They've said that they will do an equity raising by the end of June. So we'll consider that when that comes to the market, and see if we think there's value there on offer. They're still burning through a lot of cash. They, on average, we're going through about $80 million a month over the last 5 or 6 months. And their view is that they'll still be burning $50 million a month going forward between now and the end of their financial year. So an equity raising around the corner there. I guess they just need to line a few things up with the government, their largest shareholder, who said they will be participating. And then just bringing it on to A2, that needs mention. They had their update yesterday. Frustrating, disappointing update, really. The result for the half wasn't too bad, actually. It was sort of in line with what the market was expecting. It was really all about the forward-looking statement for the full year, where they're still seeing some issues with their Daigou channel into China, and some inventory build as well. Look, it's still a very good company, still generating decent earnings, decent cash. It's got, after some capital commitments, more than $500 million on its balance sheet. So just in terms of how we were positioned going into yesterday, in our core fund, we were about 40 basis points overweight. It is held in our concentrated fund. It was sitting around about a 6% weight, which matched the index weight as well. So from an index relative point of view, it wasn't too hurtful, but still very, very disappointing result on the day. So we'll continue to do work around that stock. And then finally, another one to mention is Somerset, which we like from a demographic point of view in terms of that retirement sector, and also the strong housing market, which we've seen over the last 12 months, where median house prices up 20-odd%. And so their result was solid. We caught up with them yesterday. And the outlook from here into next year and the years beyond is still very good. And so that actually is our largest overweight in our core fund, and a big holding in our concentrated fund as well. So very comfortable with that name. And finally, just in terms of some numbers around the market. So the New Zealand market, the NZX 50 is off 7.5% as of yesterday. It's off a little bit more this morning on the further move in bond yields. But a lot of that is actually driven by the electricity sector. So Meridian is off more than 20%, Contact's off 17%, Mercury's off 17%, Genesis is off 12%. And that's more related to the ETF moves on a couple of the names and the correlation in the other stocks to those names. The Contact $400 million capital raising, which is pretty chunky, which needs to be funded or tends to be funded within the sector as people rotate out of one stock to buy into another stock, which they deem cheaper on the day. And also bond yield movements as well, impacting on those. And then as well, Fisher Paykel Healthcare is off a bit, which is the largest constituent of the index. And A2, as I mentioned as well, a large member of that index. So a little bit skewed, given reporting season in general has been in line or better than the market expected. So the market movement really doesn't reflect what's going on with company earnings actually. So and then in terms of our fund performance relative to that index, our core fund is pretty much in line with that, the index move. Our concentrated fund is about 200 points better off than the NZX 50. In terms of property as well, the property fund is about 60 basis points ahead of the index, the property index, which is off about 5% at this point in time. So that's just a very, very quick summary of a few points. So I might just pass back to George.
Thanks, Mike. But we've got about 90 seconds or so left, so not too much time. But we did have a question that came in actually before we started, just around electric vehicles, and your thoughts on whether the government might be introducing road user charges for those, given that they don't get any revenue through their normal sources, either diesel or petrol driven. And what does that mean more broadly for New Zealand markets and the stocks that you're looking at?
Sure. Okay. Yeah, we do a lot of work around this. We do own Z in our portfolios. So just in terms of road user charges, firstly, ultimately, the government will have to introduce some road user charges, or at least some sort of method of people driving electric vehicles to fund the upkeep of roads. In terms of timing, I can't say. There'll probably be a tipping point where electric vehicles are maybe 5% of the fleet or something, where they have to start paying. That will probably be some time away. In terms of the Climate Change Commission report that was out a few weeks ago, their view that even if they're banning internal combustion engines by around 2030, by 2035, between 2035 and 2040, that electric vehicles will still only make up about 40% of the entire fleet in New Zealand. So we've got a fleet of about 4 million vehicles in New Zealand. The average scrappage age is about 19 or 20 years. So vehicles last about 20 years. The average age in the fleet is probably about 14 years. And we look at our window all the time and see the car carriers come into the port, dropping off more internal combustion engines every day. So the time to rotate out of our the petrol and diesel consuming vehicles is a long way away. It's a very long tail. So as I say, we do own Z in the portfolio, and we think it is a sunset industry, but it is a long way away. And so between now and then, there's some opportunity to make some money in that stock.
Excellent. And just before we close, I don't know if you can answer this in 10 seconds. My food bag, yes, no?
At this point, we've said no. Yeah. Well, we said no. Yeah. So.
Excellent. Look, maybe more on that next time. I am conscious that we want to finish it at the close of 11. So thank you, Michael. Thank you to all our speakers, and thank you to everyone for dialing in and listening to us. We appreciate your participation, and look forward to seeing you next month. Thanks very much. Bye-bye.